This is a screaming red alert buy signal. We're now up 250% year to date, turning every $10,000 into $35,000. And I'm expecting a melt up all the way till New Year's. This is the current trade recommendation for a $10,000 portfolio. So if you're on a new free trial, this is what we'd be getting you into immediately. 32 shares of ticker UVXY. That's your crash insurance. 162 shares of ticker ETHE. That's your growth asset. Ethereum, think about that as Windows in its infancy. You're super early, and this could actually overtake Bitcoin's market share, which would put it well above $20,000 a coin. You're going to be long 21 shares of NRGU. These are the big US oil companies. Mr. Biden is giving these guys a monopoly and driving the price of energy sky high. Expect record profits for these companies. Now, the more important thing is it protects your growth asset. We're worried about interest rates rising due to out of control inflation. So you combine those two and you have a beautiful setup. Then our smaller play, we're watching gas futures go parabolic in Europe. I'm expecting it to happen in the US. 10 shares of Boyle. We'll probably sell this in February and then get ready for the next massive inflation problem, which is going to be in food. So we'll be playing that early next year. So that's your current trade alert. And I want you to know this new variant spreading around the globe is extremely bullish for the entire portfolio. Biden confirmed just yesterday, no new lockdowns or mandates. He just wants to do massive testing. Who knows why? But this is herd immunity coming into the world in the next 60 days. Scientists are estimating 3 billion people will catch it in the next 30 days, not even the next 2 months. And that actually makes a lot of sense when we look at South Africa. They hit peak to trough in less than 30 days. So get ready for the grand reopening starting in March of global economies. I believe Joe Manchin and Schumer will make a deal and spend the $2.5 trillion Mr. McConnell gave the Democrats on a silver plate. China and Japan are now firing up the money printing presses. So they were letting the US do all the work for the last year. Now that we're going to have to slow down spending and quantitative easing, they know what to do. Turn on those money printers and spend, spend, spend. We're watching the credit and stimulus start to really pour through China and Japan right now. This is going to be very bullish for emerging markets. The exponential cases may slow inflation and peak CPI in the next 90 days. So I think if we're lucky, inflation is going to top out in 3 months and then start to slow down. That doesn't mean prices are going back to pre-lockdown era. It just means the exponential rising prices of goods and services are going to start to slow down, which is really important. This could cause a delay in the Federal Reserve hiking interest rates, which is going to be a massive problem for the bond market. That's now at $300 trillion in debt. Just imagine trying to increase the interest rate on $300 trillion in debt when the demographics are the big problem. In general, we don't have enough young people coming in to support all those retiring. And simultaneously, we don't have jobs for the young people anyways, because corporations are automating jobs. So this is a brutal forecast for what comes next, and we know how to play that. We want to be long these inflationary assets. Let's take a look at our two strategies. The safe growth strategy, which we recommend putting the bulk of your money behind, is up 22.86% year to date. We had a little bit of a pullback in December. We cut that pullback in half, and I'm expecting it to melt up to close the year out. The high risk strategy is up 250% year to date. Also had a little drawdown in December. We've removed 5% of that just in the last 2 days. And again, expecting the melt up to now begin. And this is really the key macro to focus on in 2022. Congress increased the debt ceiling by $2.5 trillion. What if I told you that's the only thing that really matters for stocks, whether or not the US is going to increase debt or not? And with a $29 trillion pile of debt, this will bring us up to over $31 trillion, which increases the debt by 10%. That's great news, and I'm sure the crooks in Congress will figure out how to spend the money. So if we're going to expand debt, it's extremely bullish for inflation. And those hedges that make sense are stocks, commodities, and cryptocurrencies. Our only real concern, assuming that they do spend the money, which again, I think is highly probable they will, is whether or not the bond market cracks and causes damage. So, so that's going to be our primary concern. And you can see this massive deficit that we rose in 2020, 2021. You get these beautiful stock market returns. Look at 2009, 10, 11, 12. It's really simple. The more money the US government borrows, the higher these assets go. So all they need to do now is agree on how to spend it. And if you want to bet against the government spending money, good luck to you. Trillions in corporate stock buybacks are also scheduled. We're having record amounts of stock buybacks. China will soon unleash massive stimulus. Their real estate market's at the verge of collapsing. And 2/3 of Chinese have all of their wealth in real estate. And it's not just like one generation of investment. This is multiple generations of continual investment in the real estate sector. So we're starting to see the Chinese rich freak out about this. And now they're trying to import fancy watches and diamonds and all sorts of things. So China needs to stabilize their economy and start to expand credit. And they absolutely have begun to do that. Also, the US sent over a huge amount of dollars to back the Turkish debt. Their currency has stopped collapsing, their stock markets rebound, and this is something we predicted. This is probably why the market's begun to really rebound in the last 72 hours, is this Turkey bailout, which again, this is a critical geolocation for military. There's no way they're going to let Turkey just dissolve into the abyss. So we predicted that, and it has occurred. So what we're really worried about with the way we have investors positioned is a strong labor market, which would cause rising interest rates. So it's really funny that the way the world works is if you give everybody a high-paying job with a rising wage, you're going to collapse stocks and bonds if it goes on too long. And I'll show you proof of that when we look through 1965 through 1980, the best labor market in US history, and stocks and bonds collapsed for 15 years. So good news is there's very low chance of labor growth or rising rates anytime soon. I don't think that risk is going to really appear until March. And that's based on this new variant spreading and media scaring everybody over the next 90 days. Now, it could actually peak and trough in 30 days based on all the data I have coming in. So this could actually be a little bit faster than I expected. So what are your alternatives? What else can we invest our money in? Are we going to go to cash if the government's going to debase the currency at a rate of at least 5 to 10% a year? And we're seeing true inflation in the 15 to 20% range. Cash makes no sense. Bonds need to trade at an interest rate that's above the CPI. And spoiler alert, it's 5% below the inflation. So unless inflation is going to absolutely collapse and we're going into a Great Depression, the bonds really make no sense. The only people really interested in bonds are banks who have to service interest payments on trillions of dollars that are parked in bank accounts because governments worldwide printed money, handed it out, and they deposited into these banks. But the rate of this money flowing into the economy from the government slowing down, and people are going to start spending their savings. As that occurs and jobs come back online, banks will have less demand for these bonds and interest rates are likely to begin rising. This is really our big prediction over the next 5 years. So investors are having no choice. There's no logical option. Stocks, crypto, and commodities are likely to melt up until bonds become too attractive. So as the interest rate on bonds rise, they become more and more attractive, and they act like a black hole that destructs everything around them. So that's what we're going to be focusing on here. Now, if I'm wrong, our clients all have we call it the Great Depression stock crash insurance. This is the ultimate deflation hedge. Typically, people have to go to zero and cause a domino effect of selling. You need a panic, you need something unexpected that no one saw, a black swan event, and you get UVXY, the VIX, going parabolic. And this can go up well over 1,000% in a very short time period. Last 2020 March, it did just that. It went up over 1,000% in less than a month. And if you had had a 10% position, it didn't matter if the rest of your portfolio went to zero. At the peak panic, you were up. So that's the only hedge that makes sense. And it pains me because I would love to make my job much easier, giving you a big fat bond portfolio to reduce volatility in your stocks and commodities. But unfortunately, that looks like a terrible bet for quite some time. In fact, I think as the bond market does crash, the Federal Reserve will have to revert back into buying our own debt and suppressing those interest rates. So bottom line is the next 10 years looks beautiful for this setup. Now may be the best time ever to follow our high risk growth and safe growth strategy. I'd recommend putting 30% of your money in the high risk growth and 70% in the safe growth strategy. Now, the trade alert I revealed at the beginning is the high risk part. If you want to have the global equity, highly inflationary hedged safe growth strategy, you will have to upgrade your free trial. Now, let's talk big picture. Here's the big picture I see. It's inflation and it's energy costs rising, forcing central banks to raise interest rates until they break everything. Okay, and they've done this cycle after cycle after cycle. You end up with some sort of calamity. So we got the dot-com bubble bursting. Now, note, they actually tried to reduce the debt in 2001. I want to show you that. Look at that. In 2001, we tried to reduce the deficit, and you get a 2-year stock crash. The government's never attempted to do that again, which is really important for the way we're positioning. So 2001, they reduced the debt. You get a 2-year bear market. After that, they're going to go into aggressive spending and never look back. In fact, the only policy they'll consider is just how much more debt that we can stomach. And so from 2002 to 2008, they averaged approximately $500 billion of debt growth per year. Interest rates rose the entire time until it broke the back of the real estate market. You get the 2008 crisis. Okay, next round, they double down, bail out the bankers, give them a pat on the back, and average $1 trillion of debt growth. Interest rates rose till 2016 until the Fed started to fight inflation by hiking interest rates, right when Mr. Trump came on. Now we're at 2020 and we're averaging $2 to $3 trillion of debt growth a year. And again, McConnell just gave the Democrats $2.5 trillion to spend in the next calendar year. So get ready for some massive returns with very little work if you follow our strategy. Now, in general, we recommend being long growth and value at the same time. As interest rates bobble up and down with unpredictable events, these assets protect one another. In the yellow line, we can see interest rates rising last March as we passed $3 trillion in spending from December through February. And you saw your energy sector go up. And then lo and behold, China goes into lockdowns, Europe goes into massive protests over mandates, supply chains are frozen, labor market does not recover, and rates come right back down. So your growth stocks go up. Bottom line, if interest rates rise, your energy play makes money. If interest rates stay flat or go down, your growth assets go up. And if everything crashes, your UVXY play is there to save the day. So we're going to get into a lot more detail, but if you don't want to miss our next trade alert, upgrade your free trial by calling Dean at 505-322-7515. Okay, very good. So I want to jump into some content and we'll cover the exact trading recommendations at the end of today's episode. Okay, so first of all, this is going to be your best measurement of when rates are likely to rise. and it's the reverse repo operations. This is being bid up to $1.7 trillion. I'm not going to get scared out of any growth positions until this is falling off a cliff and heading towards sub 1 trillion, probably to 750 billion. Think of this as a quantitative easing buffer. We know we're slowing down the QE and getting ready for rate hikes, possibly, but this is the big buffer that's going to protect the bond market. So until that falls, we're really not going to be scared out of our growth positions. Meanwhile, are we going to be worried about lockdowns crashing the price of oil? No, it doesn't look like we need to. This new variant is 20 times more infectious, but 1/10 as deadly. So it looks like this is very good news. This is literally the cure the world needed, and nature's giving it to us whether you like it or not. So this is expected to hit 3 billion people in the next 30 days, whether you like it or not. A mask is not going to stop it, nor have you, had you taken the previous medications. We can't say the real word. Google will ban us. There's no escape. This is going to spread like wildfire, and thank goodness it's super contagious but not deadly. So this is great news for our oil play and for the reopening of the economy. Now in this chart, we're looking at the same data we saw in the slideshow, but in current times. And I've added in the banks with FAS. So that's another inflation interest rate hedge. And I just want you to see, as the rates go up in yellow, we see energy go up in green and banks go up in yellow. In red. As the interest rates go down, we saw the banks and energy companies come back down and your growth stocks go back up. So that's really how simple this strategy is. In general, my prediction are these interest rates will rise over the next 5 years, and then that's going to eventually be what snaps the economy. But I don't think we're anywhere near that point in time. Okay, now if you're in our pro safe growth strategy, we're betting big that your best returning index for the next few years will be emerging markets. It's going to be driven by China having more money to spend than the US. Remember, they didn't spend any credit over the last 2 years because they were getting massive, massive money from the United States. Now they're changing that. Now they're getting ready to spend the money as the US slows down. So I believe this is a beautiful entry into emerging markets. As you know, we use a leveraged play on that with a large part of our safe growth strategy. So get ready for this play to finally pay off. It's been a brutal year for emerging markets. Now in this chart, we're looking at the Russell 2000. This is a very good indicator of the future price of US stocks, much more volatile. Hit a relative resistance support line right here and has bounced back up. This has been trading flat all year, and I believe it's going to need the build back better spending bill to pass to break to a new high. So look for that bill to pass in January, maybe February at the latest. The timeline's not so rushed because again, McConnell gave the Democrats $2.5 trillion credit to spend more money at the government. So we're not about to fall off a cliff with the US economy anytime soon. Now here we're comparing the European markets to interest rates. This one's really set to do well if interest rates rise. And we can see it's held up really strong, even though rates crash. So very, very impressive. I do think this will also break to new highs once we pass the Build Back Better bill, which will again create more inflationary anticipation and drive those interest rates higher. And again, this is a safe growth strategy where we have a global stock portfolio. All right, the dollar was rising due to the Turkish lira. They bailed it out. So we're starting to see the dollar begin to fall down from those elevated levels. So currently at 96.13 on DXY. And again, I believe this is going to, in general, fall much further. So we've finally seen the rising dollar stabilize, and I believe it's going to most likely, over the long course of time, probably this coming year, hit 90. And that's when I intend to sell some of our inflationary bets and get more defensive. So a long way to get there. In October, we knocked out a 30% return in both strategies, and all the dollar did was fall from 94 to 93. So I just want you to picture how much money we're going to make when the dollar falls to this 90 level. It's going to be breathtaking. And that's really the big picture. If the government's going to run the twin deficits, which means we import more than we export and we expand the debt, that's the formula to drive your currency lower. And that's exactly what I believe we're going to see once we pass that Build Back Better plan. Okay, here we're looking at lumber futures. This has been predictive of the oil market. I ignored the signal this summer, and we could have taken some profits off the table, but then it rebounded back up, and it's having a small pullback. I believe this is due to lockdowns starting to occur due to this new variant. But remember, this variant's likely to come and go in 30 days and then be gone. And we may already be a week or two into that timeline. So I believe the inflation in general is not going to be contained, and that the Federal Reserve would have to hike rates aggressively to contain it. So until they start to do that, the inflation is going to remain the theme of the markets. Now let's look at natural gas. And we'll hide the lumber futures. So similar pattern developing here, and it went parabolic up into October, crashed, but now comes the cold season. So I believe we'll see this pop into February, and that's where I plan to sell boiled and then prepare for food inflation. And we know there's going to be food inflation because the fertilizer costs are up tenfold at a minimum. Some of the fertilizer inputs are up 20-fold. So you're going to see massive, massive food inflation next year. And there's really nothing that can be done about it now. So that will be the high risk play for next year. I've got some really interesting tickers to get us into that. So things like soy, wheat, and the cost of meat, I believe are going to go parabolic next year and be the new inflation. Okay, now we're looking at some of the leaders in the market. These were beaten up recently. We had much of the NASDAQ crash. So companies like Zoom or Peloton, DocuSign had gone parabolic during the lockdown, and then it crashed something like 50 to 70%. And there's only a few of these massive monopoly companies that have stayed elevated. Now, Elon said he's done selling, and we got a big jump in Tesla. There's a really funny interview with Elon in the Babylon Bee, which I'd recommend everybody watch. But in general, we're seeing these leaders begin to stabilize and rebound. And unless we think interest rates are going to rise, I believe these are going to continue trending higher. So we're seeing the same pattern in just about all of them. And again, that reverse repo is going to be the nail in the coffin to pull the trigger on getting out of, or at least reducing exposure to growth assets. Now, it's outside of the tech stocks. We have some other big leaders in the S&P 500, which include JP Morgan, Home Depot, United Health, J&J, Procter & Gamble, Visa, Bank of America, and Pfizer. And all of them are looking very strong. And in general, we're expecting over the long course of time for money to start flowing out of growth into value and essentially this group of stocks. So we're starting to see that really occur. So all very bullish signs. Now over in Asia, I'm trying to figure out when the hell China is going to stop beating up its own companies. So we see Taiwan Semiconductor is doing just fine. Really the notable company that I want to see start to rebound sharply to really tell us the emerging market's going to get red hot again is Alibaba. So we had Charlie Munger of Berkshire Hathaway buying the dip and doubling down, but it's still crashed over 56% from recent highs. And I think this will be the single best indicator that China is getting ready to really increase credit and pump its stock market back up. So keeping a close eye on that. It's stabilized, but it's not starting to rip higher. In our European index, the leaders in that ETF are looking great in this time period, up 13%, 10%, 5%. So again, really, and this is Nestle, ROG, Toyota, and AstraZeneca. And there's really not a huge position in any one company in the European index we play, compared to perhaps China with emerging markets, or the US, where you have a handful of monopolies that do get in the 3 to 5% position on a single stock. As far as calling a top on our NRGU play, instead of looking at technical analysis of a 3 times leveraged product, I would recommend not doing that. Instead, let's look at the fundamentals for one of our bigger companies in that ETN. So Exxon. This administration is making it very hard for anyone to expand their oil business. So it's really the big boys who are already established, have a monopoly to dominate for the foreseeable future. And the outlook is the cost of oil is going to go up as the economy reopens. And that is pretty much set in stone, unless there's a black swan event that causes everybody to stop using energy. I believe the cost of oil is going to rise, and the group of 10 US oil companies will dominate the profits from this. So look for Exxon to hit 100 and for DXY to hit 90 to sell that NRGU position. And it could very well send NRGU, currently at about 160, to somewhere between $450 to $600 a share. And that's because it's a leveraged 3 times play. So that's one of my biggest bets for our clients. Now, we're not just going all in on just oil and gas. As you know, it's really there to protect those monopolistic growth companies that we have huge exposure to. All right, in this chart, we're looking at interest rates and the price of oil, and it's problematic. The interest rates are not keeping up with the price of oil. Now, if I zoom in, they did pull oil lower, but let's remember what happened. We had 5 major companies release their strategic reserves, which are supposed to be used for wartime. So stupid. And then we have this new variant causing some short-term lockdowns. What do you think is going to happen to oil as everybody gets herd immunity and we start to reopen the economy probably in March? Oil is going much higher. That's really very, very likely. Where do you think interest rates are going to go once we pass the Build Back Better plan and have massive debt being issued? Interest rates are going higher. So that's really our key focus over the, really, I think this is going to be the trend for many years to come. And it's going to catch a lot of people off guard who just love their Google, Apple, Facebook without understanding macroeconomics. Okay, another commodity we're looking at is copper. China is the biggest driver of copper prices. China's been very, very cheap with spending over the last 2 years. What do you think is going to happen to copper demand when they try to bail out their real estate sector and start pumping trillions of dollars through their economy? Okay, obviously, most likely copper is going to go higher. Now, if we zoom out, copper's at the highest price in its history. So very, very interesting. If copper falls off a cliff, I would be very surprised, and that would probably actually get me to get defensive. So far, with China in a no spending mode, trying to fight inflation, it's holding at the highest prices in history. So what's going to happen once they start to try to drive demand into their economy back? This probably is going dramatically higher. Okay, another inflationary read is looking at the Baltic Dry Index. China is locking things down. They have this zero COVID policy. Hopefully that doesn't get us banned. Shouldn't have said that word. We're at record levels, even at the 50% crash we just had. Again, what's going to happen once these variants work its way through the world? Probably this is going dramatically higher. So again, we've seen it stabilize at record highs after crashing. Same pattern that we saw in lumber, but lumber went back up. So keeping a close eye on it. These are the products we're watching to try to predict the path of inflation. Okay, this is really bad news. We got the 2-year bond going up 330%, and we have the 30-year essentially trading flat. So the bond market's telling us the inflation's a huge problem. The Fed's going to hike rates to fight it, and they're going to crash the economy. So that's what the bond market's telling us. We really want to see the 2-year either stay flat or come back down, and the 30-year to go up to predict that the economy is going to not have a crisis due to the Fed hiking rates. So for this to happen, we really want to see the producer price index start to flatline, come down, wage pressures to slow down, and the CPI ultimately to start to flatline and come down. I think we're going to hit peak CPI in 90 days, and that will be very bullish if I'm right. If not, we could be seeing an economic crisis due to inflation and the Fed hiking rates sooner than I thought possible. Because I was in the belief that the Fed would do everything possible to avoid crashing the economy prior to the uh, midterms next winter. So this is the developing story, and probably the most important chart. If you just wanted to watch one chart, watch the 2-year and the 30-year. And again, in general, you want that 2-year to stop going up, and you want the 30-year to go up. And if that occurs, we likely have a really robust recovery underway. But right now, the bond market is telling us trouble ahead. Here's a look at 3 critical bond markets. And again, that's not trouble ahead right now. That's trouble ahead after the Fed actually goes through with rate hikes, which at the earliest would begin in March. Now, TLT, JNK, LQD represent the access to credit for corporations and the government, which you could just think of as the single biggest corporation in the world. Right now, they're not crashing, so everybody has access to cheap capital. So we're not worried about stock buybacks slowing down, and we're not worried about the government spending slowing down. All very bullish for how we're positioned. This chart, we're looking at whether or not we want to be aggressive in Bitcoin or Ethereum. In the safe growth, we're going with the safer bet, Bitcoin. In the high risk, we're going with the higher risk bet, Ethereum. Now, if we go back this far, Bitcoin is dominating, better returns, less volatility. It's only been in recent months that we're starting to see better performance from Ethereum. And even in this most recent stretch, it started to outperform. So in this small stretch right here, it had a better return on the upside from October through November. And then when the market pulled back, it had less drawdown. Is Ethereum trying to take the lead against Bitcoin? 2 different products. So very interesting. I like both. Ethereum needs to create successful software to overtake Bitcoin. Right now, the only success story that's really notable is Uniswap, which I'm a big fan of. So we need a lot more success stories in Ethereum. But right now, it's in proof of work. It's switching to proof of stake. And with Polygon, they're trying to make it more efficient to operate on that blockchain. Right now, it's highly inefficient. Competitors like Solana, Cardano, Polkadot, and Avalanche do a far better job, but they're switching to proof of stake. That could be what it takes for Ethereum to finally overtake Bitcoin over the next 5 to 10 years. And if so, Ethereum would skyrocket to well over $20,000 a coin. Okay, failure to create successful software applications will be the demise of Ethereum. So it's still a big gamble. Furthermore, proof of stake is unproven in terms of being able to protect the blockchain. It really incentivizes a super rich entity to be able to control the blockchain. Now, would you want to go spend hundreds of billions of dollars to destruct Ethereum? Probably not. But that's the main concern, is that proof of stake could have more concentrated power with a wealthy entity compared to Bitcoin with proof of work. So it's not clear which one will be the best performer. Um, I like both currently, and we have access to both in the stock market with the Grayscale Trust ETHE and GBTC. These products absolutely will not like the bond market crashing. And in 2018, when that 10-year started to rise due to rate hikes, crypto crashed first, emerging markets crashed second, European markets crashed third. And then when the 10-year hit 3% in October, we got that big crash in the US stock market. So nothing likes rates rising. And that's going to be your single greatest concern if you're long crypto. That's why I've got you hedged to the brim with oil and gas, the ultimate rising rates hedge. Okay, gold and silver just been boring. Really funny. A big gold silver guy is Peter Schiff. One of my friends was out in Florida at an NFT conference and was sitting next to Peter Schiff. So what's he doing at an NFT conference? But a lot of people have been looking at the gold to silver ratio, and that has gone really, really bad. Speculating that silver could have a really good year coming up. Keeping a close eye on it. We have a small silver position in our safe growth strategy. Okay, for hedges on deflation, I'm not a big fan of the dollar. We're running twin deficits. I believe the rising dollar story will reverse soon as the Build Back Better plan is passed, and that will also be detrimental to treasuries, which we would play with TMF. I might have liked TMF as a hedge for the debt ceiling, but McConnell caved and gave Democrats $2.5 trillion to spend. So the dollar and the bond market make very little sense at this point in time. So we want to bet that if there's a black swan event and something caused selling, to directly target US stocks, which have outperformed everything else by many, many, many multiples. So that's where you could hit a lottery ticket return right now, is UVXY. I don't see anything else that would do a good job at aggressively hedging a inflationary portfolio, which we currently have you positioned in. All right, next chart, we've got rare earth metals, RAMX. There's just not enough lithium and cobalt in the next 5 years. They need to increase the supply 20-fold, and there's just no way. It's not possible. The cost to set up a mine is hundreds of millions of dollars. It takes years just to get it ready, and we're way behind. That's why REMX is going up so quickly, and why China is so excited about Afghanistan withdrawal, because they're now getting ready to load up on the biggest supply of lithium in the world right there. So that's a huge play. Unless we're going to hike interest rates and crash global economies, I think REMX will be a great performer, and we have a big position in this for our safe growth strategy. Now, if we're going to try to reduce risk of warming up the climate from CO2 by making everybody drive electric vehicles, that's great, but not if you power them with coal plants. So nuclear power is going to be critical. The other play that we got out of for the time being is TAN. I'm going to throw it back on there. Solar and wind could help with this. Nuclear can help with this. But if this is really a problem, then that's the solution. And so long-term, most likely TAN and URA will be very, very handsome returns for investors. In the short term, we're long Boyle, betting that the cost of natural gas is going to go up as an inflationary spike through winter. All right, here's that NRGU play. This is essentially the top 10 US oil companies leverage times 3. So if we're going to see Exxon potentially double, then you're going to get 3 times the return here. So that's how you get to 450 just from Exxon hitting new highs. So very easy calculation there. Super bullish on this, as you know. I'll be willing to take profits off the table if DXY gets close to 90, which I think will occur as we, again, pass the Build Back Better plan, which I don't think will happen until late January, early February at this point. Okay, is China really going to collapse? Probably not. Their currency's strong. Sure, the stock market's down, but they've been targeting the stock market on purpose. Okay, so it's not like fundamentals in China have collapsed. The government's literally been attacking. Uh, they're trying to redistribute wealth essentially, and come across as a populist, socialist government that's going to take care of everyone. Um, so I'm not worried about China destructing their economy in the long term. In fact, it looks like they're setting up for a very nice stretch. Okay, threats to Bitcoin and Ethereum are Binance Coin, perhaps, Solana. Not a big fan of Ripple. Cardano certainly is a threat to Ethereum. Terra Luna is making big waves, and then Avalanche and Polkadot. Polygon's a extension to Ethereum. So those are really the main threats we need to worry about if we're long Bitcoin or Ethereum. I would say are Polkadot, Avalanche, Cardano, and Solana. At this point, we need to see what the impact is for Ethereum switching to proof of stake. Are they going to destroy the competition, or will it just keep them in the lead? We'll see. Gold copper ratio, they call it Dr. Copper. If you're going to bet big on gold, just realize you could make potentially a lot more money long copper and oil if we're going to actually recover labor. I'm going to show you in a minute, there's 10 million job openings. So there's a probability that these jobs could very well likely come online. And as wages continue to rise, that's going to become more attractive. And as savings dwindle, people will become more motivated to go back to work. And again, that's in general what I believe will happen slowly but surely over the next 4 years. In this, we're looking at when the market's anticipating the first rate hike, which could start a cycle that's not friendly to growth assets, which would be tech stocks and cryptocurrencies. Right now, the market's betting it will begin at least an announcement in March and potentially actually hike a rate up in March. To avoid this, we must see PPI flatline very quickly. It rose month over month, and we need to see CPI flatline and start to come back down. And again, it rose month over month. This is going to be the big story of next year. Now, here's our yield curve. And it's all jacked up. So we really want this to be sloping like a ramp. And instead it's not. It's doing more like a hill thing with an inverted 20-30 year. I'm going to show you what the healthy one looked like. Oops. Okay, so this is what we like to compare. Okay, so October, before we did a bunch of stimulus of 2020, we had a nice looking yield curve. Okay, now what's happened since then? We've had the 2-year go parabolic up several 100%. That's why everybody thinks they're going to have to hike rates. And then we've had the long end start to fall. Okay, that's not good. That's signaling the Fed's going to hike rates and break things. Now let's look at what happened after we passed big stimulus. We saw the front end stay flat, and then we saw the long end rise. So the bond market liked it at first, thought we were going to have a nice recovery, and then things fell apart throughout the year, and those interest rates came back down, and the front end came up. So the bond market's not predicting very good things at this point. This is the VIX futures curve, and everything is really squeezed together. So it looks like the risk is not really priced in very much outside of January, February right now. And that means we really need to pass that spending bill, which will then start to drive those rates higher. And then that will become probably showing more risk farther into the future if those rates go too high. Here's a look at some of these competing cryptocurrency assets. All of them had a sell-off with rates going lower. That's highly unusual. But Polygon is actually up 48%, Ethereum down 8%, oil down 12%, Bitcoin down 15, Solana down 18, Cardano down 23, and Polkadot down 31. So I say buy the dip. Looks like a great opportunity in the short term. All right, so let's take a look at this new variant. We're having skyrocketing cases in the UK. Now they're in winter, and they're older, and have all taken the medicine. If we go to South Africa, it's warmer, they're younger, and almost none of them have taken the medicine. So South Africa hit peak to trough 30 days and did no damage to the hospital system. We'll see if this pattern plays out. For the UK, there's data coming out of Scotland already saying this is about 1/5 as deadly as the previous variant. Now let's look at that curve for South Africa. And again, we can see cases really started to go parabolic on December 1st, hit a peak by December 12th, and it's already collapsing. So actually less than 2 weeks to hit the whole population and come back down. Let's see what we're looking at in the US. Now remember, we have aggressively increased testing. So is it really more cases or is it more testing? People are studying the level of this disease in the sewage, and it's indicating that we're missing a lot of the infections. But here you go. It began to rise rapidly in the last week. So I anticipate we will hit peak cases by New Year's and then start to come back down if we follow the same path as South Africa. So it'll be a very short-lived panic on this. Rate of change of cases is starting to rise. I was anticipating this would begin sooner, but now it's coming in. CDC's estimating, everybody's estimating these cases are about to go parabolic. And if you ship out 500 million test kits, which we just did, well, I'm going to bet that these cases go up. This is where we track debt issuance. I don't care how much money Janet Yellen wants to raise if the reverse repo is over $1 trillion. So the more the merrier as far as we're going to analyze that. Non-farm payrolls, weak print last month. They keep revising these up later. And again, we're really in an economy that if the job market gets too strong, then all the stimulus has to slow down, interest rates rise, and then the tech giants who control America see falling stock prices. So they really don't want jobs to come online. This is the core inflation rate, which jumped. I wasn't sure if it would flatline, jump, or pull back. I was sure it'd be above 4. So this came in hot at 4.9. Studying people like Jeffrey Gundlach, I think we're going to see it potentially go up for the next 3 months. So there's be more and more anticipation of rate hikes. And that's going to be problematic. So this is really a key to watch. We'll see what this comes in for the next 3 months. Then the lockdowns occurring potentially slow demand, but if they're happening in Asia, they're going to slow down the supply chain. So are we hurting the supply chain more than we're hurting the demand side? That's really the big question. So we will see. The rent is likely going to drive this much higher and represents a huge chunk of the CPI. And that's expected to be problematic for the next year. So we'll see. And then the energy inputs also rising. So this could turn into a bigger problem than most are anticipating over the next 6 to 12 months, which is problematic leading into midterms as well. So this is very, very interesting. Banks are loaning money. We're really positioned for that. Consumers are borrowing money. We're positioned for that. Retail sales continue to go to new highs. We are positioned for that. There's a look at that consumer spending slowing down, but not crashing. Job openings hit almost a new high at 11 million jobs. So the risk of jobs coming online are certainly there. Turkey probably caused crypto to go down recently, Stephen. Turkey probably caused everything to go down recently. Okay, producer prices was flatlining and then jumped, not good. We really want to see this stop rising so rapidly. Jobless claims, not falling to a new low. Wages continue to rise. This is all inflationary pressure. Now, the growth on the salary growth is slowing down. Labor force participation, way below. We're down 4 million jobs. Primarily, it's from seniors retiring. They made a bunch of money in their stock account. They don't want to risk getting sick, and they don't want to deal with this new world we're living in. So will they go back to the labor market? Maybe not. This is going to be very interesting. And again, it would be problematic for markets if they did. It's going to drive interest rates higher. Now let's just review. I told you that the worst returns in stocks in history were the best times for your average Joe American. And so from 1965 to 1980, you had out of control inflation. You had Paul Volcker jacking up interest rates all the way to 20%, and stocks and bonds took turns crashing for 15 years straight. So what I want to tell you is, if we're going to have lots of jobs come online, we're going to have out of control inflation, and it's going to persist for years and decades, then we have to change our strategy completely the opposite of how we're betting currently. So we will see. I don't believe we're going to see labor force rise for very long. In fact, I think it's going to have, I think we're going to be very lucky if we can get back to the 2020 levels. So we'll see if we can even accomplish that before we worry about a decade of job growth. Because again, the big picture is corporations are automating jobs and processes, and they don't need all this labor to produce the goods and services of the economy. So politicians are left with no choice but to dole out free money to stay in power. And so that's what held up the Build Back Better bill, is free child tax credits. Joe Manchin didn't want to subscribe to with an indefinite period of time. All right, so twin deficits. The trend is it's getting worse and worse unless you get very populist policies and want to decouple from China. This is going to just get worse and worse. So I don't see those policies at all in this administration. So I'm not worried about the balance of trade improving. And even with the populist president, it didn't improve. And now again, they didn't actually manage to pull off what he was trying to do, which was force big corporations to manufacture in the US. Tried to, but they got his ass out of there right away. And then we get Biden in, and this has gone just screaming lower. So I believe this will continue to trend this direction, and very important for how we're positioned against the dollar long term. Personal income is not falling off a cliff. All the bond bulls are predicting that would have happened months ago, as a lot of the government benefits have rolled off. Not happening. China's PMI has slowed down, but they're getting ready to print money. They just imported more goods than they ever have in their history. China's getting ready to dominate global economies and markets, is my main theory over the next 5 years. Is global demand crashing? No, we just had record Chinese exports. So not buying into any of that. European PMI is slowing down, but again, China's getting ready to put the money printers to work. All this talk of ending QE and fighting inflation, and the central bank just put our balance sheet at a new high. This is going to break 9 trillion before they end this period of printing, as the government has to borrow trillions every year for an indefinite period of time. Don't worry, they're going to be back to printing money, because those bond rates are going to rise if they don't. So very good setup for how we're positioned long term. Europe just hit a new high, 8.5 trillion, and Japan just added a couple $100 billion to their balance sheet. Who's keeping track? As long as it's going up. Okay, very good. So let's refresh my Twitter feed. Okay, Jim Bianco is saying the inflation is becoming a political problem. It's either kill inflation at the cost of the stock market, or keep the stock market going up and keep the inflation running. So we'll see if they can weave a delicate balance and accomplish both. But in general, our main problem will be interest rates rising, and we're hedged against that with NRGU. So I think that's most likely the first thing to occur is the rates rise, tech stocks, crypto sell off, and buy up banks and energy companies. If the inflation gets too hot and demand collapses, and then the opposite, then we see the value sector crash hard with the growth sector, and all the money flows into the dollar and the bonds and the put options. I don't see the demand collapse occurring first. So I think that's the order we need to be worried about. Now, again, the Fed can speed that process up by hiking interest rates. He's talked in this thread, there's a bunch of it. He's basically saying what I was telling you. If you watch the long end, that's predicting the economy long term, and the short end predicting the rate hikes. And so the bond market does not like what it sees. He's saying there's 3 rate hikes priced in already for next year. So that gets us up to 1%. Now on $300 trillion global, you need to realize this is going to affect interest rates on every bond on the planet and drive them all higher. So if you're not ready for high interest rates to rise, you better. This is a study out of Washington predicting 3 billion people will be infected over 3 months, which is good news for how we're positioned, assuming it leads to reopening. Spain's PPI hit 31. Wow. Or 33, excuse me. We really need to see these PPIs globally start to slow down. Otherwise, the Fed likely will have no choice. Biden extended the debt payments for college loans. Again, Daniel D. Martina Booth is worried that we're going to have a fiscal cliff this year and that we need to keep the money flowing. Otherwise, the economy is going to crash. Here's a look at the Chinese credit impulse starting to bottom out here. This could be extremely bullish for emerging markets if they do increase credit, which is likely to occur as the US slows down. Chinese rich are not investing in real estate and starting to buy Swiss watches and all sorts of things, as they're worried that the real estate sector has been crashing in China. And again, they're going to have to support that. China imposes a hard lockdown in a city, Xi'an, with 13 million people. So once again, it's a double-edged sword. These lockdowns in Asia make inflation rise because it makes it more expensive to get goods over here to the US. And the lockdowns in the US are probably just going to get more Amazon orders because you're stuck bored at home. So this is potentially going to drive that CPI higher, which again is going to be a big problem. So we're watching that carefully. Another way to look at the inflation is the container ships waiting off the Pacific, new high. Now they're starting to just kind of float around and not be on the coast, but again, no sign of weakness in the inflation. So that's how we're betting right now. We're betting that the inflation's not going to end anytime soon, and the Fed's not going to do anything about it yet. So that's how we're currently positioned. This is some data potentially predicting the inflation is going to peak here. So again, there's just so many factors. We're just going to have to watch this every month and react as we get the data in. This is interesting. $30 billion has flown into venture capital for crypto in the last year. So this space is taking off, and we're at the very beginning of it. I'm very excited about this space for our clients. Okay, very good. So I'm going to go ahead and switch back to this slide deck. All right, guys. So if you're watching this video on YouTube, you're going to get cut off of the best part. I'm going to reveal exactly how to invest your money and what trade alerts I see coming down the pipeline. So don't delay. Call Dean at 505-322-7515, because when you upgrade, you're going to gain access to the membership area, which has our turnkey software where you can punch in how much money you want to invest, and it'll automatically tell you exactly what to buy. Okay, very good. So now we're going to throw up the disclaimer so the authorities don't bug us, and switch into members content only.